Hi, I'm Stephen Burns at Primary Mortgage Resource, and today I want to talk to you about discount points and what do they mean for you. So let's start with, what is a discount point? So a discount point is where you could pay upfront in fees to buy down the interest rate. So a point is 1% of the loan amount. So if you're going to pay a point to buy down the interest rate, say that 1 point is going to buy down the interest rate. This can change depending on the market, what type of loan, so on and so forth. But let's just say you're going to pay 1 point to buy down the interest rate 1/4%. So that 1/4% is going to save you in the long run on your monthly payment, and you're going to eventually make up for the upfront cost by saving on the monthly payment. Now, I'm not usually a huge fan of paying points on your mortgage, and there's a few reasons why, and I can kind of go over the details of that in a minute. So let's start with a scenario. Say you're buying a $625,000 house and you are putting 20% down. Well, if you were to buy 1 point in discount points, let's say that you're going to get 1/4% interest savings on your monthly payment. And that 1 point is going to cost you $5,000. So if you're going to spend $5,000, get 1/4% interest savings, that's going to be $71 a month on the savings. Well, a quick, easy math that I use to see if it's worthwhile is take the upfront cost, the discount points, divide that by the monthly savings. So 5,000 divided by 71 is 70 months. That's almost 6 years to get to that break-even point. It's going to take you 70 months. Well, with that being said, most consumers don't keep the same mortgage or house for more than 5 years. And that's something to really consider, because a lot of things can happen in a 5-year period. Well, a couple things such as you move, you refinance your home, maybe you want to pull out some equity to do some home improvements. What if interest rates get lower? They go from 4% back down to 3%. You maybe refinance it in the next 12 months or 3 years or whatever. Or worst case scenario, something happens in your family, you get a divorce. That kind of stuff can happen. So it's hard to predict what's going to happen in 5 years. So if you're going to be banking on breaking even after 70 months, well, that's a pretty far projection that you're going to keep that same mortgage, let alone the same house, for the next 70 months. So my recommendation is, if the break-even period is more than 48 months, really not worthwhile. If it's less than 48 months but more than 36 months, it's worth talking about. It really just depends on your situation, if you could really guarantee yourself that you're going to be there long enough. If it's less than 36 months, it's probably worthwhile. Then if it's less than 24 months, it's almost always a no-brainer in my experience. But I'm not someone that pushes for it. There are some lenders, like you want to go to some of your online lenders, and they basically quote every rate with 1 point in discount points, where for myself, I quote without discount points. So that's just comparing apples to apples. What you see is not always the same by the time you look at the fees and the closing costs. So if you have any questions, let me know. With that scenario, if you'd like me to run some other scenarios as to how discount points might work for you, the biggest thing is, when is that break-even period, and does it really make sense for you?